Welcome everyone to Supply Chain and Country Risk Assessment, a webinar part of RiskMinds Digital Week. I'm Lena, Head of Communications at PANGEA-RISK, and I'd like to welcome Robert, CEO and founder at PANGEA-RISK, and Bilal, Head of Risk Forecasting at PANGEA-RISK. Today we will discuss navigating country risk in a changing world, the impact of war in the Middle East and maritime disruption along key trade routes, how to balance risks and opportunity in high growth and high risk markets in Africa, and planning for climate change and its effects on country risk.
Hello and welcome everyone. Welcome to this recorded webinar called Navigating Country Risk in a Fast Changing World, which we deliver at RiskMinds Digital Week on the 18th of June. And it is a pleasure to be with you today. My name is Robert Besseling. I'm the CEO and founder of PANGEA-RISK. PANGEA-RISK is a specialist intelligence advisory, providing analysis and forecasts on country risk to support our clients' risk mitigation strategies and to help identify new business opportunities. And I'm joined in this webinar by my colleague, Bilal Bassiouni. Bilal, how are you today?
Hi, Robert, and hello to all the listeners to our webinar. It's a pleasure being with you today for this very interesting topic. Just a quick introduction about myself. I am the head of risk forecasting at PANGEA-RISK, and hopefully today you and I can unpack some of the very interesting developments going on around the country risk world, particularly to very fast and changing developments that we've seen over the past year.
Indeed, it has been a fast-changing world, Bilal, hasn't it? And I know that RiskMinds attracts quite a few chief risk officers and risk professionals from across the board. And many of the audience may have a financial look at risk or a cybersecurity focus on risk. We at PANGEA-RISK focus on country risk, particularly on emerging markets. And here you can really see how we quantitatively rate all recognized countries around the world. And we do so on a methodology that integrates political, security, and economic risk perils. And obviously, this is done on a scale, and in this case, color-coded. So unsurprisingly, countries like Russia or countries like Argentina, currently in sovereign defaults, will be rated in red, while other countries have a more benign country risk outlook, like Scandinavian, Australian, or Canadian parts of the world, which are rated in a more benign blue color. But you may be used to these kind of heat maps. And for our methodology, we've been challenged over the past few years by the fast pace of change around the world and new threats and opportunities emerging for countries, particularly for emerging markets. And what Bilal and I are keen to do with you today is to identify at least 3 key trends that are changing the way that we at PANGEA-RISK look at country risk and rate emerging markets across the world. And one of the first instances, one of the first main trends that we would like to highlight is supply chain, and supply chain disruption in particular. Because over the past half a year, we have really seen the impact of choke points in global maritime shipping routes take a hold on economic and country risk forecasts globally, both in advanced economies and in emerging markets. What do I mean by these choke points? There are several primary choke points which have been mapped here on this same PANGEA World Global Risk Ratings map, based on the main maritime shipping routes around the world. Unsurprisingly, the Strait of Malacca from Singapore, Indonesia, and Malaysia is mapped here. It's a strait which is very much problematic due to congestion. Or the Panama Canal in the Americas, which started 2024 with the potential of running dry due to drought in the Latin American region and causing the threat of shipping being rerouted around the Americas. But the real focus of our conversation here is the choke points focused around the African and Middle East region, particularly the Suez Canal, the Bab el-Mandeb Strait, and the Strait of Hormuz, which, if we zoom in to this African and Middle East region, are neighbored by countries that are all rated in this severe or high risk category. So these are countries like Sudan and Yemen, and indeed Israel currently, which are all facing severe political, economic, or security perils. And that is impacting some of the major choke points around the world. Maybe, Bilal, you are leading maritime insight for PANGEA-RISK at the moment, a special feature looking at how country risk intersects with maritime risk. Can you guide us through what has been happening in the Strait of Hormuz first before we run through the other choke points?
Absolutely, Robert. I think the Strait of Hormuz has been a very strong anecdote to the problems that we're seeing, the challenges that has been developing in the Middle East region over the past few months. Given the significance and the strategic importance of this port, particularly to crude oil exports, as we see in this graph, primary GCC countries really depend on this choke point for their crude oil exports. Approximately 20 million barrels per day are exported from this port, and virtually all of Kuwait, Iraq, and Qatar's crude oil exports go via this choke point. Hence, threats, even if not serious or hasn't manifested yet by Iran to close this choke point or to disturb trade flow or maritime trade from this choke point, is and will be taken very seriously, particularly from a supply chain perspective. Majority of these exports will go to either Europe or Asia, the Asian market. Hence, any disruptions on the crude oil exports make it very difficult to mitigate and also very difficult to circumvent. And again, we see on this graph how the positioning of many of the oil refineries and oil export companies in the Middle East, and how they are congested towards closer to the Persian Gulf, the Arabian Sea region, and hence making it very difficult to navigate the disruptions that may arise from disruptions around the Strait of Hormuz. Even though there are alternatives that that have been discussed around, for instance, circumventing or working around disruptions around the Strait of Hormuz, such as the East-West crude oil pipeline. This again just pours into the Red Sea, which, as we know, is already going its own set of issues, particularly if the imports come down from the northern Red Sea towards the southern Red Sea, closer to the Bab el-Mandeb Strait. Those exports, of course, will be then heading towards Asia, the Asian markets or the African markets. That again is facing disruptions because of the current Houthi, Yemen-based Houthi attacks against shipping lanes, against the shipping lane, and against particularly those that are deemed, party to the conflict in Israel. So again,
interesting, yeah.
This shows really that we are going through a period of extreme volatility, and this is definitely transferring and manifesting also in the maritime sector, particularly at one of the two most crucial choke points that you've discussed earlier.
How interesting, Bilal. I mean, basically, whoever controls the Strait of Hormuz has a chokehold on global oil supply, right? That's basically what it looks like here. And beyond the Persian Gulf, I mean, you already mentioned there's the whole Red Sea, which has two choke points. And this is, if you remember the map we showed earlier, it's full of countries rated in a severe country outlook, with the Suez Canal and the Bab el-Mandeb Strait being two separate choke points, again, being party to various different perils, onshore country risk. And the conflict between Yemen and Saudi Arabia, of course, has posed a threat to Red Sea shipping. But it's not just on the Arabian Peninsula, because similarly, that there has been a push by Ethiopia in the Horn of Africa to seek access to the Red Sea, even belligerently through Eritrea or Somaliland. There is a dispute over the Grand Ethiopian Renaissance Dam between Egypt, Sudan, and Ethiopia, which again makes this Red Sea region more volatile. Sudan is now well over a year of acute civil war and causing the largest displacement crisis in the world. Egypt may have avoided a sovereign default, but of course the country is very much exposed to the situation in neighboring Gaza, where similarly we have seen Houthi artillery strikes and missile strikes at Eilat in Israel, all causing volatility around this Red Sea region. So this is certainly making the major container shipping companies around the world rethink how they crisscross from east to west. If you want to connect from the big Asian ports like Shanghai or Shenzhen or Singapore to the big ports in Europe like Antwerp or Rotterdam or Hamburg, or even the east coast of America, the normal route is through the Bab el-Mandeb Strait and the Suez Canal. And now certainly we are seeing that many of these container shipping companies are no longer taking these traditional routes. And all this volatility as well is starting to draw concern about the long-term viability or sustainability of China's signature policy of the One Belt and Road Initiative. The BRI has 3 routes. One is the Arctic route, which is still very problematic in terms of ice and length and navigation. There's the overland route, which is again susceptible to supply chain problems, regulatory issues, war in Ukraine and other parts of the overland route. So it's really been that maritime route which has been key for the Belt and Road Initiative. But if the Red Sea is not viable, then we need alternatives, don't we, Bilal? I mean, you know, how are we going to be able to ship goods from east to west without relying on our traditional routes for shipping, or even the BRI? What's possible here?
As you mentioned, Robert, so countries are trying to now find strategic alternatives, particularly to these challenging and historically traditional maritime routes from the east-west. And for instance, as this map shows, the IMEC corridor was designed to complement existing the maritime and the railroad transport route, such as the Suez Canal that you've covered, and also the north-south transport corridor and the BRI route that we've discussed. So to enable hassle-free transit between, India, the UAE, Saudi Arabia, Jordan, Israel, and Europe. But the recent conflict, particularly in Gaza, has stalled the IMEC project at this moment. So even this alternative is not viable anymore. And again, highlighting the vulnerabilities of this corridor's design, particularly to geopolitical tensions. This corridor, as we see in this map, really transits high-risk regions and very volatile areas. So in event of escalation once more, this corridor can be easily targeted or easily impeded, such as that we've seen, for instance, in the Suez Canal. So the threat actors, again, will have access to disrupt the same route. Hence, we're hearing talks about the redesign of this route, possibly include Egypt to circumvent the volatility around Israel and Gaza.
Interesting. I heard Turkey as well recently, but try and bring Turkey into this. They're quite keen on this potentially, right?
I mean, any country that will have influence on such an important route will, of course, amplify its geopolitical standing and its economic, returns out of this project.
Except, of course, when there's no infrastructure. I mean, what is all this talk about shipping around Africa? Is that still happening?
Absolutely. the Cape of Good Hope, as we've seen in this chart, is really seeing an uptick in movement around it, and we've seen also a massive decline in ships trying to transit the Suez Canal for obvious reasons. Of course, insurance costs are extremely high going into that region. Besides, also the direct physical security risks towards maritime operators. Hence, more and more operators are still choosing to go around the longer route around the Cape of Good Hope, even despite its that being more expensive route. Again, the problem. This presented a massive opportunity for Africa for obvious reasons again, but because of the lackluster status of many of the ports around in Africa, Africa was not able to capitalize on the opportunities presented by this rerouting around Africa, particularly South Africa, for instance. The status of its logistics sector has been really poor, and also in addition to labor strikes that has really tarnished and severely impacted the logistics sector, made the returns or the capitalization around of ships porting and using the services of the logistics sectors around Africa, particularly South Africa, has been really poor and minimal at this stage.
Phenomenal, yes. A big labor strike started in Nigeria in early June, and of course the ports there have been affected by this. The Kenyan ports in Mombasa are frequently targeted by labor, and these are some of the world's poorest managed ports in the world, according to the World Bank, I read recently. So there's no real viable opportunity here. And you know what the problem with this is that this type of supply chain disruption has an impact all across the world. And usually we were talking about inflationary impact on advanced economies, but we have to bear in mind that the countries that may see a lagged effect and therefore a more acute effect remain these types of emerging markets, already vulnerable markets in the Middle East and Africa that actually surround these choke points of trade. So countries like Zimbabwe and South Sudan have seen hyperinflation again spike in 2024. Turkey and Egypt and Nigeria are trying to stabilize their inflationary outlook. But then some countries like Sierra Leone or Ghana, again, are seeing food prices skyrocket, as you see on this chart. And that's all coming at a time when Africa in particular is seeing lots of electoral activity. I mean, we have recently seen big elections being concluded in Argentina and in India, but Africa has really seen in 2023 and 2024 a record number of electoral cycles. Some which have been highly volatile, like those in Senegal or South Africa, but lots of policy uncertainty around those votes, and others which essentially are keeping the long-time regimes in place, like, for example, in Chad or in Togo. But it is all coming at a time when food prices are skyrocketing, causing political instability risks. And we at PANGEA-RISK, we advise our clients that, you know, it's not really coups or sovereign defaults that are actually causing real disruption risk to investments. It's more nuanced perils, such as policy uncertainty and contract revisions, or in the context of inflation in particular, foreign exchange shortages. And last year, we saw various different countries around the world suffering from these types of foreign exchange shortages. Bilal, you have looked extensively at Egypt and Turkey over the past few years. You've covered these countries extensively with all their forex problems. Throughout Africa, there were concerns about Zambia and even big mining economies like the DRC and South Africa. And that's really then leading us to potentially the second big topic that Bilal and I want to talk to you about today. And that's the future technologies and renewable energy technologies that are driving demand for critical minerals. Critical minerals that are really being sourced from places like Africa and increasingly the Middle East. And there are growing or intensifying geopolitical rivalries surrounding the mining of these critical minerals. And interestingly, we are always talking about Russia and China in the Western world, the competition between these markets, between the West and the East, will create the geopolitical rivalries of the future. But in fact, it's particularly the competition between the European Union and the US over critical minerals that is driving this type of global superpower rivalry to secure these supply chain ingredients for the fourth industrial revolution and indeed the green energy transition. Every country in the world ranks these strategic minerals differently. And I think it's interesting here in particular, the EU and the US have far more competitive critical minerals than China and the US, for example. Yeah, Bilal, you've done some quite extensive research on this recently. Walk us through, what are critical minerals? Where can we find them? What's happening here on this map, for example?
So this map really shows diverse locations of the very essential, important minerals that will be, of course, used in the fourth industrial revolution, particularly around future technologies. And as we see in this map, the concentration so far of a lot of these minerals has been in Africa and also Latin America, but also we're seeing countries like Australia, the US, and China having strong reserves of some of these minerals. China, for instance, does not only have quite an abundant reserves of some of these strategic minerals, but also has a strong lock and hold over the processing of these minerals. So they're the biggest sources of these minerals, particularly from Africa, but also the far more advanced countries when it comes to processing. Thereafter, we see, for instance, in Africa, particularly around Southern Africa, we're seeing countries with strong reserves around very critical minerals. But what is also interesting and often goes underreported is the Middle East, particularly Iran, which has untapped reserves of lithium, possibly the second largest reserves holders if explored after Chile. Jordan is also trying to explore this market around critical minerals, particularly with components that will be very important for solar panels. So slowly we're seeing countries, particularly in Africa, in the Middle East, really exploring the opportunities that is associated with critical minerals. Again, in Africa, for instance, one of the most one of the countries with the highest reserves of, for instance, iridium is South Africa. And it will be interesting to see, particularly given the volatility that the country is currently experiencing from a political position. We just saw elections, for instance, happen over the weekend in South Africa, and how this will, the outcomes of these elections and the political stability or instability will definitely have a spillover effect on the country's ability to further explore and export its very in high demand minerals that the country possesses at the moment.
How interesting, isn't it? And yes, South Africa is definitely one of those countries which is going through policy uncertainty and political instability following those elections in May. But the other big countries on that map you showed earlier there, Bilal, are countries which have really big security problems and political instability problems. In May, also, the Democratic Republic of Congo reported that there was an attempted coup or an assassination attempt on the leading political figures in the country. And the whole area of the DRC that borders Rwanda and Uganda and Burundi are some of the most violent parts of the African continent. So, many investors have been put off. But there is a misperception, we believe, surrounding countries like the Democratic Republic of Congo, which often capture negative headlines. But yet, many large investors around the world are all now seeking to move back into the DRC or into the DRC for the first time to secure access to critical minerals, despite the political and security problems. And that's because, first of all, geographically speaking, many of the copper and cobalt mines are all the way in the Katanga region that you see in this cutout of the map here. far away from the volatile border area with Burundi, Rwanda, and Uganda. And similarly, many of the political issues are not actually causing the type of turmoil that we've seen in other countries. In fact, the political outlook for the Congo has been relatively stable, despite the negative headlines over the past few months. The country now has a government and is dealing with its economic volatility through support from the IMF and seeking more and more investment, not just from China, where previously we've seen Chinese investors being the primary investors in the DRC, but now increasingly from Western investors. A really good example is the extent to which the US and the European Union and a number of African development finance institutions are all collaborating to build up regional infrastructure to avoid copper and cobalt having to be trucked all the way down to the port of Durban in South Africa, but instead can be railed out across the border through an existing corridor to the port of Lobito in Angola. This is a multi-billion-dollar rehabilitation and expansion of an infrastructure corridor that will revolutionize the way that the West in particular will be able to access critical minerals that are so vital for the fourth industrial revolution and the green energy transition. As I mentioned, this is a corridor that's all about the West. It's China and the West playing off here over the Lobito corridor. But Bilal, I've been hearing more and more interest from the middle powers, so to speak, from the Gulf region. Are they active on the African continent as well?
It's an interesting phenomenon, Robert. Over the past few years, we've seen particularly Saudi Arabia and the UAE take a massive interest around around strategic minerals and critical minerals, and particularly we've seen trends that show that these countries have been very methodical around its approach to critical minerals on the continent. Initially, the interest has been, countries based in North Africa, where they have historical and fraternal relationships with. But more recently, we're seeing government-to-government investment deals being signed, particularly around construction and environment. So the Gulf countries are finding a window, particularly regarding these investments, and they are exploring it to the best of abilities. And we must understand that these GCC countries have a particular advantage compared to to China, for instance, Russia, or the West, for example, the US. The advantages comes where they are non-aligned and they do not necessarily associate political developments in those countries with these strategic and economic outcomes. Hence, they are more favorable in terms of these deals, and are also backed with massive amounts of investments from the very, very large buffers that they do have in some of those investment accounts. So, and we've seen this, of course, as we see in this graph, translate into major investment deals, particularly, for instance, in the financial services sectors, the transportation, warehousing, environmental technology, ICT and electronics, and construction. And they have been quite diversified in those investments. Again, similarly, in this graph, we can see the focus of some of these investments from the GCC around critical minerals, quite specifically, and they have been, as I said, quite diversified around the countries that they've been, speaking to or coming up with these arrangements and partnerships with. The biggest, of course, source of some of these FDIs and investments has been Egypt, but slowly we're seeing countries in sub-Saharan Africa take in a leading role. Of course, the UAE still is the primary investor on the continent, but quickly and fastly, Saudi Arabia is also increasing its investment portfolio, and this is expected to be a growing trend around the continent, where GCC money is likely to play an important role around critical minerals.
Phenomenal, isn't it? How suddenly, over the past few years, as you mentioned, these Gulf states are rivaling Chinese and Western countries. Infrastructure build up, accessing critical minerals across Africa by building all these new ports. It's not just about the US and Europe building Lobito. You said the UAE is the primary investor at the moment. I mean, you can see here from this PANGEA-RISK research, you've got DP World and Abu Dhabi ports building brand new ports or expanding existing ones to cut into the African continent. You mentioned Saudi Arabia, Bilal, as well. I believe the Saudi mining company is now also tapping into Zambian and Congolese minerals with US financial backing. And yeah, you also mentioned this is very methodical. This is a process. It is not a whimsical outreach, almost or an opportunistic one, as potentially or arguably Russia has been doing. So let's take a step back here, because we've talked a lot about the opportunities around the continent, but we have to look at some of the main risks as well. At PANGEA-RISK, we look at political, security, and economic drivers of risk, and people often associate elections with political instability. And certainly in Senegal and in South Africa so far in 2024, that is certainly true. Far more so than the spree of military coups that we have seen in Africa over the past 4 years, where in fact, arguably, military coups have actually maintained some political stability in some parts of Central and West Africa. Insurgency and insecurity rarely impacts commercial interests, but food insecurity, according to our PANGEA-RISK ratings, has been a primary disruptive threat to commercial operations. Bilal, you look at supply chain risks and maritime insecurity all the time, and we've talked about this extensively already. We also talked about foreign exchange shortages, in particular how these are more prevalent and more likely to cause a commercial disruption than, say, a sovereign default. But there's a whole other angle that we haven't talked about yet. And as we are essentially redrawing how we should be rating country risk around the world, there are other factors out there which are not usually included into country risk forecasting methodologies. And one of the major ones that we at PANGEA-RISK are now also integrating into our methodology is the impact on country risk of climate change. Bilal, you have done quite a bit of reporting for PANGEA-RISK recently on all those extreme weather events happening in Africa, the Middle East, and elsewhere. Talk us through what's been going on in 2024 so far.
I mean, besides all the geopolitical issues that we've been discussing, and that has really caused unprecedented disruptions, we are also compounded with the adverse effects around climate change, particularly the El Nino effect that has been, really peaking its devastation and devastating implications over the past few months. We've seen, for instance, high levels of rain causing flooding in East Africa, and also more rarely in the GCC areas and around the Gulf. But we've also seen heating effects particularly around Southern Africa, Latin America, and also Australia. And more we're seeing Europe experiencing unprecedented heat levels. And this year, for instance, is forecast to be one of the hottest years, summer periods in Europe's history. And basically, this has impacted supply chain in several ways. For instance, we've discussed already the Panama Canal and how the drought there has impacted shipping passage volumes on the canal. Really, particularly beginning of 2024, we've seen a decline and congestion around the canal. But we've also seen disruptions to, for instance, cocoa production in West Africa, particularly Ghana and Cote d'Ivoire, and also drought conditions in Southern Africa that has massive implications for staple products, particularly maize production, which again will have spillover effects, particularly on inflation, and hence socio-economic conditions become more difficult. And then we see a rise in unrest and a rise in other associated political risks and country risks.
Indeed, yeah. And Bilal, you know, as we are seeing more and more people being impacted by these climate factors, how is that impacting country risk as well? There must be huge displacement here of people, and there must be more and more disputes around water and land. I mean, you mentioned cocoa and maize already. I assume cocoa is really for chocolate manufacturing, but maize, that has an impact on food security, right? What's happening in the context of Africa, for example, in terms of these phenomenal weather patterns?
This will definitely change the way we measure and understand risk, particularly over the coming period, because what we're seeing, because of these adverse and difficult living conditions, particularly from weather changing patterns, we're seeing more and more informal forms of migration from areas where there's water scarcity, and we're seeing more conflicts based particularly around water rights, grazing rights, and also in increased levels, for instance, of xenophobic attacks in countries that are receptants for some of these for some of these migrants. For instance, we've seen more and more protests in Tunisia and in South Africa around foreign nationals, particularly from formerly disadvantaged communities from other countries that are based in those countries, and also the herder-gatherer conflicts that we're seeing, for instance, in Nigeria and in West Africa. So these patterns around conflicts and our understanding around how risk can be measured is definitely going to need to change to accommodate this the widening and the widening drivers of conflict, and the widening drivers must include now climate change and environmentally driven issues.
And you're right. You and I are both country risk analysts, and we've always looked at internal drivers of risk in countries as being the main determining factors for how we forecast risk, how we rate countries. But increasingly, it is outside external factors that are driving country risk as well. And the main drivers of external risk are the ones that we've been talking to you about over the last half an hour or so, where supply chain and maritime trade disruption has had a really important risk on food inflation and interconnectivity of different continents and regions around the world. We've also looked at the geopolitical rivalries of critical minerals, and indeed the impact on country risk of climate change and extreme weather. At the beginning of this year, PANGEA-RISK worked on a really interesting project together in collaboration with a sovereign risk insurance based in Bermuda on trying to integrate all these drivers of risk into a forecasting methodology. And here we looked on this map that you can see, we look at issues such as currency and convertibility, elections in 2024, political and security problems, sovereign debt, of course, as well. But on top of that, this map has also looked at maritime trade choke points that are driving country risk. It looks at the contract risks facing critical minerals, and indeed also the patterns of climate change around the world. And this has been a really interesting project for us at PANGEA-RISK to try and integrate everything that Bilal and I have been talking with you about over the past half hour, to integrate this into a forecasting methodology. And that's exactly what we at PANGEA-RISK do, and what we are very proud to present to Risk Minds Digital Week this June. Indeed, we will also be in person participating at the London event in November, the main Risk Minds conference in London, where again we'll be hosting a roundtable on country risk in emerging markets. Before we get there, I believe that at this stage, if you have joined Risk Minds Digital Week, you will be put through immediately to the live Q&A session for this webinar with Bilal and myself. If you are seeing this recorded webinar or any other means, then this is where we are going to say goodbye to you. But before we do so, Bilal and I have shared quite a few of our infographics and charts and maps with you that are part of our PANGEA-RISK research. If you would like to have access to these infographics and some of this research, you can actually download a compressed PDF copy directly onto your phone or other device by scanning this QR code, and it will give you a complimentary copy of this presentation that Bilal and I have presented to you today. And to everybody else, we thank you very much for your interest in PANGEA-RISK, and potentially we hope to see you at Risk Minds in London. Thank you very much for your attention. Goodbye from Bilal and myself.